Right now, there's a lot of global capital stuffed into U.S. equity markets. It's not really been like this since around the dot-com bubble. And if you do start to get rate cuts, you could get foreign equity holders pulling out from the U.S. market. We're setting up at least a potential for significant capital rotations out of large cap U.S. low volatility equities and into other parts of the U.S. market, as well as other parts of the global market. Should the Fed even have a mandate? You can chalk up to maliciousness, you can chalk it up to incompetence, but there are serious issues with the data, and I would say with the entire model of essentially governed interest rate to begin with. Currently, my base case is bullish on Bitcoin over the next 18 months.
Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
As the U.S. Federal Reserve hints at upcoming interest rate cuts, the financial world is on edge, anticipating a possible seismic shift in capital. This move could trigger a significant flow of investment out of the U.S. and into global markets. But what does this mean for U.S. stocks, gold, Bitcoin, and emerging markets? In recent years, interest rate cuts have frequently resulted in a weaker dollar, reducing the appeal of U.S. assets for foreign investors. In contrast, emerging markets and commodities like gold tend to benefit as capital shifts in search of higher returns or safer investments. The impact on Bitcoin, a digital asset that's increasingly significant in the global financial landscape, could be just as substantial. Are we on the verge of a global capital shift? Let's explore this further. Lyn Alden, founder of Lyn Alden Investment Strategy and a highly respected expert in institutional level research, recently shared her insights on the looming interest rate cuts. She provided an in-depth analysis of how these cuts could reshape the economy, detailing the potential impacts on various asset classes and underscoring why this moment could be pivotal for investors around the globe. Before we get into her insights, if you're finding value in this content, make sure to hit that subscribe button and turn on notifications. It's the best way to stay ahead of the curve with expert analysis that can help you navigate these uncertain times. Now, let's explore the interview and hear what Lyn has to say about the Fed's next move and its implications for the market.
I think that market consensus is pretty accurate. My base case would be 25 basis points, wouldn't be shocked by 50 basis points. And what the Fed tends to do is they tend to send speakers out with statements that kind of shift the market's perception that, if the market was over expecting 50 basis points, while the Fed was expecting probably 25 basis points, they'd probably start sending out some slightly hawkish speakers, and vice versa. If the market wasn't expecting 50, and they were intending to do 50, they probably would start sending out more dovish speakers. So for these near-term cuts, I would expect, that the market pricing is fairly accurate. I think we're going to see a mild set of cuts coming up.
The Federal Reserve strategy of using subtle yet effective communication tactics is crucial for investors to understand. By leveraging public statements and speeches from key officials, the Fed can influence market expectations and guide investor sentiment. This approach allows the Fed to manage perceptions and prepare markets for changes in policy without making sudden or disruptive moves. Historically, the Fed has often employed this tactic to prepare markets for interest rate changes, minimizing the risk of shocks that could destabilize the economy. For instance, in 2019, ahead of the July rate cut, Fed Chair Jerome Powell and other officials hinted at policy easing, which gradually adjusted market expectations and reduced volatility when the cut was eventually announced. Lyn's expectation of a mild set of cuts suggests that the Fed is likely aiming for a measured approach, possibly to avoid triggering panic or overheating the economy. Given the current economic indicators, including inflation trends and labor market conditions, a 25 basis point cut seems plausible. However, the possibility of a 50 basis point cut can't be ruled out, especially if economic data starts signaling a sharper downturn or if global risks intensify. For investors, understanding these nuances is critical. A smaller rate cut might suggest that the Fed believes the economy is on relatively stable footing, which could support equities, particularly in sectors like technology and consumer goods. Conversely, a larger cut could indicate more significant concerns about growth potentially driving investors towards safer assets like bonds, gold, or even Bitcoin as a hedge against economic uncertainty. With the global markets watching every move, the Fed's upcoming decisions could be a turning point. Investors should stay tuned, as the next few weeks could provide key signals about the direction of not just U.S. monetary policy, but global capital flows as well.
And so going back to the prior point, one of the things I did in the book Broken Money was I was very critical of central banking in general. So they when the economy is going strong, they start to raise interest rates until they kind of pressure it. And then when it starts to blow up, they cut interest rates and they try to reinflate the next credit cycle. So they're kind of, in theory, supposed to be a counter-cyclical force, but in practice they end up being a lagging pro-cyclical force. They contribute to booms happening, and then they're unsustainable, and then they contribute to popping the booms that they themselves caused, and then they try to reflate the bust that came from the boom that they broke, right? So it's just kind of this repeated cycle of putting out fires that they themselves at least partially started. I'm fully critical in that sense. And as far as how assets should react, I mean, basically they tend to react in a delta to what happened versus what is expected. So if the market is but as we get closer, those probabilities for what's going to happen in September will be more and more locked in. And then when the event happens, if it's what they expected, I wouldn't expect particularly explosive asset price changes that week or that day. But if something deviates significantly from what they expected, we could see, if they cut more than expected, we'd probably see a bigger jump in gold, potentially Bitcoin, than what was priced in. So I don't specialize in these kind of multi-week or multi-month trading ranges. Right. I'm structurally bullish on gold and Bitcoin. And then when it comes to equities, it really depends on what sector, what jurisdiction of equities, what valuation. So there's some types of equities I'm quite bearish on. There's some types of equities I'm quite bullish on. And I think we're probably going to see rotations in the quarters ahead. But I wouldn't read too much into any one rate cut period.
So what are you expecting in terms of a continued rate cycle?
I think. Yeah, basically I would expect a kind of a gradual rate cut path unless or until we get some sort of credit event. If a credit event does not materialize of significant scale to start breaking the market in some way or get unemployment to spike above, say, 4.5%, you'd probably expect mild cuts. If you do start to get some of those events, we could start seeing 50 or 75 basis point cuts at a time. My general base case would be to see a higher low in interest rates. So for about 40 years, we saw lower highs and lower lows of interest rates, both short end and long-term interest rates. And this kind of post-pandemic hiking cycle broke that trend for the first time. We had a higher high in interest rates, both for the short end and the long end. And I think the thing we have to see next going forward, in my base case, is are we going to get a higher low in interest rates? So they could cut interest rates down to eventually 2 or 3% for the cycle, but it would still be above the zero that they held it for much of the prior decade. And should that be the case, I would generally expect that the cuts are not going to be as effective for large swaths of the economy as they normally are, and that's because generally when they hit a lower low in interest rates, there's a lot of refinancing activity among existing mortgages. Everybody can basically kind of refinance their mortgages and basically get a free lunch. They just kind of refinance and lock in a long-term lower rate. And if we get a higher low in interest rates, then really the only people that it makes sense for them to refinance are the ones that originated mortgages in the past 2 years or so. And that activity was very low because of how high the rates were. So there's not a lot of refinancing activity if we get a higher low in interest rates. It would be beneficial for small businesses around the margins that generally borrow at shorter durations from banks. It could be potentially beneficial for some marginal commercial real estate, marginal banks that lend to commercial real estate. There would be parts of the more cyclical economy that would be helped by those rate cuts. But the largest part of the economy, kind of the homeowners and the investment grade corporations, a lot of that would be fairly unaffected.
Lyn Alden offers a thought-provoking analysis of the Federal Reserve strategy on interest rates. especially in the context of the post-pandemic economy. The Fed's approach raising rates during economic upswings and lowering them during downturns has traditionally been viewed as a means of stabilizing the economy. However, she points out that, in reality, central banks often end up intensifying the very economic cycles they aim to control. Alden highlights the possibility of a higher low in interest rates during this cycle. Historically, interest rates have followed a pattern of decreasing highs and lows, which has facilitated widespread refinancing and reduced borrowing costs. But if rates settle at a higher low around 2 to 3%, the broader economic impact could be more subdued. This scenario could particularly limit refinancing opportunities for homeowners and large corporations that previously benefited from ultra-low rates. As public debt levels continue to climb, the expense of servicing this debt becomes a growing concern. With interest rates potentially stabilizing at higher levels, the government's debt servicing costs could become a significant issue, sparking renewed debates on fiscal responsibility and debt management. Regarding asset classes, her analysis points to a nuanced outlook. While she maintains a bullish stance on gold and Bitcoin, the performance of equities is likely to vary depending on the sector and region. Investors should be ready for shifts in the market as the Fed's policies evolve and avoid overemphasizing the impact of any single rate cut. The future path of interest rates is clouded by uncertainties around inflation, energy prices, and fiscal policies. Alden's prediction of an era marked by sideways, choppy interest rates suggests an economy that could become less responsive to modest rate changes. This shift may lead to a reduced role for monetary policy in driving market movements, with other factors, like fiscal policy and global economic trends, taking on greater significance. For investors, this outlook highlights the need for diversification and a focus on sectors less sensitive to interest rate fluctuations. The end of the zero interest rate policy era could mean that the straightforward gains of the past decade will be harder to achieve, necessitating a more strategic approach to investment.
That gives a portfolio inflation protection. And so it actually helps to kind of clarify what the 60-40 portfolio does first, which is to say that the classic 60-40 portfolio, especially one that's just inherently U.S. equities and then U.S. bonds, that's a portfolio that's very weighted toward disinflation, right? So it generally, stocks benefit from disinflationary growth, and then bonds benefit from disinflationary recessions and things like that. Whereas the decades where both stocks and bonds do rather poorly, especially in real terms and sometimes in nominally terms, is when you have decades of inflation. So whether you look at the 1910s, the 1940s, the 1970s, or the 2000s, those were kind of the four inflationary decades of the modern era. All of those were ones where a combined stock and bond portfolio was not a particularly good one in real terms. And what did do well was that third component, which is some combination of commodities, commodity producers, especially energy producers, ideally gold, kind of hard money. In the modern era, that can include Bitcoin. Basically having that kind of that more inflationary protection side holds up pretty well in those decades where specifically stocks and bonds don't do particularly well in real terms. And if the challenge is that, when you look at that kind of commodity side on its own, it's not historically a great performer. They during decades where stocks are doing amazing, that other side is generally languishing. I mean, if you look at the performance of oil or gold over the past 10 years, or energy producers, or the commodity sector as a whole, not very strong. But during those decades where it actually does well, it kind of saves a portfolio. So when you actually incorporate that into a broader portfolio, it really improves kind of the long run risk-adjusted returns. The 60-40 portfolio became popular specifically in this 40-year window of ever-falling interest rates. It's only really back-tested that far. Whereas when you actually include a longer-term period, and you take into account those inflationary decades that tend to come fairly reliably based on the commodity capex cycle and other matters, I basically argue that it's useful to not have a 60-40 portfolio and to instead have at least some gearing in the portfolio toward those inflationary assets.
And of course, you group Bitcoin in that category.
Yeah, I think it's we don't have obviously the long-term track record of those other decades like we do with gold or with energy, but it fulfills a similar purpose, which is that it's money with a finite supply. There's some disadvantages relative to gold, that it's got a shorter track record. It's a different type of money, but it's got some advantages, which is that it's globally portable, much easier than gold. It's got a lower supply inflation rate than gold, and I would say it's still below its total addressable market. So it's still held by very kind of a small percentage of people in any meaningful capacity. And so I think now Bitcoin is in that bucket of probably harder assets you want to hold if you expect ongoing currency debasement. If you expect positive real rates for foreseeable future, and you expect good equity growth, then that's kind of a case to just you can own equities, you can own those types of assets. But if you do expect long-term currency debasement and kind of risks from all this kind of policy materializing, that's where assets like gold and Bitcoin and things like energy producers can come in really handy for a portfolio.
The traditional investment strategy of balancing equities and bonds has been a cornerstone for achieving growth and stability, especially in disinflationary times. However, this approach has shown vulnerabilities during inflationary periods, such as the 1910s, 1940s, 1970s, and 2000s, when both asset classes often struggled. In these challenging environments, portfolios that included commodities, energy producers, and precious metals like gold provided much-needed inflation protection. Today, Bitcoin is also being recognized as a hard money asset with potential to safeguard against inflation, offering benefits like global portability and a lower supply inflation rate. The past 40 years of declining interest rates have been favorable for traditional portfolios, but this success may not continue as inflationary pressures rise. Therefore, it's wise to diversify by adding assets like commodities, gold, and Bitcoin, which can enhance resilience and improve long-term risk-adjusted returns. As we face an increasingly uncertain economic landscape, relying solely on traditional investment strategies may no longer suffice.
Generally speaking, the biggest correlation I've found to Bitcoin price is global liquidity. And there's multiple ways to measure global liquidity. The one I tend to use is global broad money supply denominated in dollars. And so there's both a credit creation component and a dollar index component to that liquidity measurement, which is relevant because of how much dollar-denominated debt exists in the world. And generally speaking, when that's doing well over a given 6-month period, normally Bitcoin's doing well over a given 6-month period or 12-month period. And when that's doing poorly, usually Bitcoin's not doing great either. That can't really tell you what's going to happen on a given week or even a given quarter. But over a 12-month period, if you have a high conviction on the direction of global liquidity, generally speaking, Bitcoin is a good way to express that, especially if you look at other Bitcoin-specific indicators. So if you look at, for example, the market capitalization of Bitcoin relative to the realized capitalization of Bitcoin, which is another way of saying the on-chain cost basis of Bitcoin. So every coin priced the last time it moved on-chain in dollar terms. You can look at the multiple between market cap and then the cost basis during those really big bull market tops that generally have a 3-year correction after them. Usually you get a very high gap between market cap and realized cap. So far we've not really hit any of those extremes in this cycle. In addition, whenever you have a really strong bull market, you do generally get selling from longer term holders. Someone bought Bitcoin 5 years ago and they might be up 5x in their position. Maybe they want to buy a house and start a family, or maybe they just want to diversify to some extent. Maybe Bitcoin's now 90% of their net worth and they want to trim it back down. You start to see selling pressure from those longer term holders that are significantly up in their price action, and that kind of exhausts some of the incoming demand eventually. That's kind of what contributes to the bull market's ending, along with liquidity rolling over. And so far in this cycle, there's only been kind of a modest amount of that longer term selling. So I don't really consider that this cycle has hit any of the extremes of prior cycles. And so the combination of being pretty positive on liquidity for call it the next 18 months and not really seeing too much excesses in the Bitcoin space currently, my base case is bullish on Bitcoin over the next 18 months.
How bullish?
I mean, I'd be
Yeah.
surprised. I'd be surprised if we don't hit six figures in this cycle. Whether it's 18 months, if I give myself some extra room and say 24 months, I'd be surprised if we don't hit six figures. We could go way north of that. Like we could, I wouldn't find it inconceivable to go well into the six figures. But I try to have conservative estimates, and I would say that generally speaking, if we're having a conversation 2 years from now, and we've still not seen 100K, despite having a positive liquidity cycle, I'd be surprised. If something happens to impair the liquidity cycle, like let's say some war breaks out and the dollar index spikes to 110, or if you get an event like that, kind of like how in 2019 anyone predicting that what's going to happen next year would have been blindsided by COVID. So if you get something like that prevents global liquidity from going up like I expect it to, that would not surprise me to see Bitcoin have a rough time. But I would be surprised not to see Bitcoin notably north of here if we do have another 18 months of rising liquidity.
Bitcoin's outlook appears positive. Historically, Bitcoin's price has shown a strong correlation with global liquidity, particularly the global broad money supply in dollars. When liquidity increases, Bitcoin often sees a boost in performance. Current indicators are encouraging. Bitcoin's market capitalization relative to its realized capitalization, which measures the on-chain cost basis, has not reached the extremes seen in previous bull markets. This suggests the market is not yet overheated. Additionally, selling pressure from long-term holders has been modest, indicating that major profit-taking hasn't significantly impacted the market. If global liquidity continues to improve, Bitcoin is poised for potential growth, with the possibility of surpassing $100,000 within the next 18 months. However, unforeseen events such as geopolitical tensions or major economic disruptions could alter this trajectory. For those interested in the evolving landscape of Bitcoin and global liquidity, staying informed and adaptable is key. Keep an eye on market trends and be ready to adjust your strategy as needed. For more insights and updates on Bitcoin and other financial topics, don't forget to subscribe and hit the notification bell. Thanks for watching, and see you in the next video.